Bitcoin has just been through a absolutely brutal 52% crash from its all-time high. And right now, in February 2026, we're at a serious make-or-break moment. You've got top analysts who just cannot agree on what's next. Some are calling for a massive rally to $225,000, while others are warning of a drop to $75K or maybe even much lower. Seriously, the next few weeks could set the tone for the entire year.
So that puts every single investor, probably you included, in a really tough spot. You're facing the exact same high-stakes question. Is this the dip you've been waiting for, the buy opportunity of a lifetime, or is this just the first tremor before a much, much bigger earthquake? What you decide to do right now could be absolutely critical. Okay, so how in the world did we get here? Well, rewind to October. The market was on fire, pure euphoria as we hit over $126,000. But, the party came to a screeching halt on January 30th. Why? The nomination of Kevin Warsh as the potential new Fed chair. This guy is a known hawk, meaning he's not a fan of easy money. That was the spark that lit the fuse. Just a few days later, on February 5th, bam, we got a massive capitulation crash that wiped out billions in risky bets and sent Bitcoin tumbling all the way down to 60 grand. To help you cut through all the noise and confusion, here's our game plan. First, we're going to lay out the bull case for a huge rebound. Then we'll flip it and look at the bear case for an even deeper crash. We'll also see where the big Wall Street players are placing their bets. And we'll finish with the 3 key signals you absolutely have to watch to see which way this is all going. All right, let's kick things off with the bulls, the optimists. Their whole argument is that this crazy crash was actually healthy. Yeah, healthy. It shook out all the gamblers and the weak hands, setting the stage for a much stronger, more sustainable rally. So the big question is, could they be right? Fundstrat's Tom Lee, who's a huge voice in this space, believes the rules of the game have totally changed. He's basically saying, forget what you know about Bitcoin's old 4-year cycles. He thinks the insane demand from these new Bitcoin ETFs, plus an eventual friendly pivot from the Fed, will create a tidal wave of buying that's unlike anything we've ever seen before. And that new reality leads to some pretty wild numbers. I'm talking about $225,000. Analysts like Tom Lee see this as a real possibility for late 2026. So we're not just talking about a recovery here. We are talking about a brand new, explosive phase of price discovery, all fueled by that big institutional money. But look, this dream scenario doesn't just happen on its own. For it to become a reality, a few massive things have to fall into place perfectly. First, the Fed has to start cutting rates, and not just a little. Second, those ETFs need to keep sucking in more than $10 billion of new money every single quarter. Third, the amount of Bitcoin available on exchanges needs to keep shrinking. That's a classic supply shock. And finally, we need to see big companies start buying Bitcoin for their treasuries again. But what if none of that happens? What if the stars don't align? Well, that brings us to the other side of the coin, the chilling bear case. And it argues that the crash we just saw wasn't the end of the pain. It was just a warning shot. Now, the initial bear target is actually a failure to recover, with the price just struggling to get back above $75,000. But honestly, that's not the real fear. The real danger is what happens if we break down from where we are now. Many analysts are warning that if our current support levels break, we could be looking at a much, much steeper fall, with some models pointing as low as $38,000. And if you look at the on-chain data, it tells a pretty worrying story. You've got this huge divergence. The whales, the giant accounts we call smart money, have dumped over 81,000 Bitcoin in just 8 days. And who's buying it? The smallest retail wallets are grabbing it up at the fastest pace in almost 2 years. This is a textbook distribution pattern, where the big, informed players are quietly handing their bags over to the crowd. So you've got this perfect storm brewing for the bears. You've got the Warsh effect, which could mean a Fed that's openly hostile to risk assets. The ETF money, which was a huge support, is now flowing out. We just saw how the whales are selling to retail, and all of this is happening while the broader global economy looks really fragile, with investors running for safety. Okay, so we've heard the extreme optimism and the extreme pessimism. But what about the big Wall Street firms? Where is the institutional money actually placing its bets? Well, they're carving out a much more moderate path right down the middle. If you look at the forecasts, Standard Chartered is targeting $150,000, banking on slow and steady ETF growth. Citigroup is a little more conservative at $143,000. JP Morgan is using their interesting gold comparison model, which gets them to 170,000. And then on the higher end, you have Maple Finance at 175, and they're really counting on those Fed rate cuts.
So the main takeaway here is pretty clear. The big banks are still bullish, but it's a very cautious bullishness. They see a clear path to new all-time highs, but they think it'll be driven by steady institutional money, not another speculative frenzy. And you can bet they're keeping one eye firmly on the wider economy. All right, we've gone through the bull case, the bear case, and the Wall Street take. Now for the most important part. Let's boil all this down to the actual measurable signals that you need to watch. Forget the noise, forget the headlines. This is the data that will tell the real story. There are really only 3 things that matter. Number 1, keep your eyes glued to those ETF capital flows. If we see them consistently pull in over $10 billion a quarter, that is a massive green flag. Number 2, the Federal Reserve. Will we get at least 2 rate cuts this year? Yes or no? That's a huge piece of the puzzle. And number 3, watch what's happening on crypto exchanges. Are coins continuing to leave? Because if they are, that's your signal that a major supply squeeze is coming. And to make it even simpler, here's your immediate checklist for this month, for February. Things turn bullish if Bitcoin can break and hold above that key $65,000 resistance, if the ETF flows start turning positive again, and if the Fed starts sounding less aggressive. The bear case takes over if that critical $58,000 support level fails, if the ETF outflows get even worse, and if the Fed stays hawkish. It's that simple. So there you have it. The cases have been made. The key signals are clear. After a 52% crash, this market is like a coiled spring, just waiting to snap one way or the other. So the final question is for you. Which way does it break? Do you think we see a recovery up to $85,000 first, or are we going to take another painful drop to test $50,000? Let me know your call in the comments below.